Hi, this is Randy Finney with the Right Side of the Chart, and this is a late session update for Wednesday, June 18th, 2025. It is 3:35 p.m. as I'm starting the video, so we have a little less than a half hour to go in the trading day. Um, Pretty much an uneventful day, especially for a Fed day, but again, that was to be expected as I commented on. I'll get to that in 1 second. Here's what I'm going to try to do in this order if you want to skip ahead in the video. As I often do, I'll start out with the equity markets, very brief overview. Not much to report when you're flat. The S&P and the Nasdaq are flat today. No new developments, but I'll touch on those. Then I'll hit on crude oil briefly, which I've been highlighting and very much in my focus recently, along with followed by Treasury bonds. When I hit the equity markets, I'll try to get on the VIX as well, cover that. That's very closely related. Then the U.S. dollar. And that's very much related to gold, silver, and GDX. And then time permitting, I'll try to hit on some of the recently highlighted individual trade ideas, individual stocks and or commodities or whatever else we're trading. But if I can't get to those, we'll do it in a separate video. All right, so starting out in the equity markets, again, Fed Day. Normally you get a lot from me leading up to Fed days, and I tell you that's, market can break and it's going to break one way or the other. This time around, I've been talking about it when I cover the economic calendar and over the last week or so. Told you we'd have the Fed meeting today, but also said it would be a non-event. There was a virtual 100% certainty based on the Fed funds futures that the Fed would make no change to rates, and that's exactly what happened. Not only that, Powell's comments were kind of cross currents that wash out each other as far as any rate cuts or hikes. One was they acknowledge or looking at the kind of skew towards the risk of inflation, popping back up or continuing being elevated right now. So they kind of ticked up a little bit there. They're worried about inflation, rightfully so, as I've been talking about. We have now a pretty real conflict in the Middle East. This is, I think it's being underpriced in by the markets. This is outright. This isn't just rhetoric anymore. Hamas, which was kind of an independent group being attacking Israel. It is Israel, bombing, aggressively attacking Iran. So, and then trying to suck the U.S. in, or not trying to. I shouldn't say that. We're one of their staunchest allies. You guys know what's going on. Either way, say what you want about the war. Please keep the political comments, unless they have to do with the market, keep those off the site. Again, if it has something to do with the crude oil or how it might impact something or a trade idea, great. All I was going there is, yes, it certainly puts a net tailwind under the price of crude oil, which is, of course, inflationary. So the poor Powell, can't catch a break. You had the tariffs, which created uncertainty, and then the market's like, whoo, we dodged a bullet there. But that takes time. So the market has already started to discount, no effect from the tariffs. Again, that certainly a lag time there. And now crude oil, again, how long and how bad this gets and what impact it has on crude additionally will yet to be seen. I'm going to get to crude in 1 second. So let's park that for a second. Let's look at the equity markets first. Let me just start out here and talk a little bit about what's going on. When we look at the S&P 500, we can look at VTI or whatever. Well, just look at the S&P 500. Nothing has changed in my technical outlook. If you're brand new to the site and you want an update, bump me under this post, put a comment in there. I'll give a link to one of the recent videos, but I'm not going to go in. In fact, I have kind of cut back on this. When there's no news to report, if you live in a small town, I remember, growing up in Miami in the 80s, 70s and 80s, we had more, the news was, you could sit down and grab a tub of popcorn. It was interesting every night, shootings and, the Miami River cops and what scandal was going on here or there. And then I moved, when I went off to college, Tallahassee, Florida, first time I watched the local news, I was like, what in the hell? Farmer Brown grew an 8-pound pumpkin. There was nothing to report, even as a state capital, but it was, basically podunk town. Point being that when there's no news to report, anything exciting, they have to fill that 30-minute time slot. I don't here, so I'm just going to tell you there's nothing new in the charts in the last few weeks. In fact, let's just get a little granular on it here. And what I'm going to say is I'm going to, until we start getting, until we break one way or another, my updates will be light, but I'll, continue to update at least every day or every other day, brief updates like this. So this is the S&P 500. And so when volatility is high, you move quick. Back here, when the market bottomed, I told you I was expecting a 16%, about a 16% upside in QQQ, which is exactly what we got. It was about 14% in SPY right here, and that happened literally 3 days, 3 days from the low right there, 2 days from the low, 2 or 3 days. In the last, this is SPY, the S&P 500, the market, if you want to call it that. We can look at VTI as well. This is, you can see from my pop-up box on the left, 30.1 days right now. So 1 month. We've gone where the crosshairs are, catching that high from a month ago, exactly 0.5% gain. So if you are frustrated and you're trading the markets, if that's the only trade, again, I continually harp on the benefits of diversification asset allocation. 90+% of the comments I get on the site are due to equity market analysis and trade ideas. Yet 90% of the profits come from individual stocks, commodities, everything else. Right now, look, there's times, and I will turn my hyper focus on the markets when this thing breaks and we start to volatility expands. And I still think we're on the verge of that. But as I like to say, one of my many made-up sayings in the market, in life, they say patience is a virtue. In the stock market, what I say in the stock market, patience is an absolute necessity. And so the market's gone nowhere. You need to recognize that. Nobody's making money in the broad indices right now. Over last month, we've gone again. We've gone all but about exactly flat from where we were, 0.5% higher than we were a month ago today. So that's that. Now, we did have recent sell signals. Did they play out? I thought we got the nudge. We got the little breakdown there, a back test. And so this is the chart. This is the S&P 500. So I still think, I can tell you, in my book, these sell signals are still very much intact. It's just the market's kind of flattened out here. And we need to take out each of these levels. Each of those increases the odds that the net will go down to the next one. And then if it has each of these next levels, this is my SPY 60-minute chart, are taken out, I believe the selling will begin to accelerate. In other words, you'll start going faster from the second, once the second support level is broken down to the next. I'm going to add a level right here, again, because this is QQQ, because we've gone sideways. QQQ is and has been for a while since we went covered longs here, scaled back in. We had a scale in zone somewhere in here. It was on the way up. And for long-term trades, the long-term targets, which are down 50% or so drop in the NASDAQ 100. Then more recently, right here, added a separate trade, happened to be in the same direction. There are many times I'll be long the indexes from a longer term perspective in my long-term accounts, IRAs, or short, same thing, and then taking the other side of the trade from a short-term perspective in my active trading account. Right now we have two shorts. So we have that long trade. This short, depending on how you look at it, again, everybody sees the charts different. Some people pass on these trades. Some people target the early targets and get out. Some people want to go for the deeper targets. This trade was either a successful trade. We hit T1 right there in the pre-market session and bounced. Some may have gamed the bounce. Some may have booked profits. Some may be holding out for T2. And again, based on, I added these additional targets. So from the entry point, I'm just trying to detail this trade. It was right here. Right there is where we first shorted it. That's where it was added. And so I'm measuring up. So we are right now, we're whopping 1% above that entry point. So you're 1% drawdown if you're holding out for T2, 3, or 4, with a total max drawdown of about 2.5% relative to that downside target there of about 10 to 11% to the bottom of T4 zone. So that's where it is. And this trade, to play out, well, you got to first take out 526.31. Once that's taken out, 514.30ish right there. and then T1's already been hit. So that increases the odds that if and as each of these levels are taken out, you'll go down to these. And I believe the selling will begin to accelerate. And again, just to recap what I've been saying for the last couple of weeks now, if, and yes, that is a big if, we will only know if and as we get there. But if my fourth and final near-term swing target is hit, what that's going to do on the daily chart is take us back down below these 200-day moving averages, and in my opinion, greatly increase the odds of a waterfall sell-off, especially down below 466. I think that's where you will see the VIX start to explode. So let's get to the VIX real quick. So there's the levels you have to watch short term. Again, we are within spitting distance. I know I sound like a broken record of all new highs. Any new highs, just like I was saying back here when we were in this trading range, I recognize the possibility when you get that close. Told you that I would bet on it failing and being a false breakout. The S&P did it, made a marginal new high. The NASDAQ fell a little hair shy. Or no, NASDAQ made a marginal new high. I'm sorry, this time around. It was in 2022. It fell short. And then that's what happened. It was a failed breakout. It just, sometimes the market just seems they just want to print that new high. And if it's negative divergences and overbought conditions, 99 times out of 100 in the last couple of years I've seen, it's been at minimum a tradable correction. At minimum, every time it's done that, including right here. And at maximum, one of these may be much more than just a tradable low single digit drop. So, all right, now let's go to the VIX. VIX volatility index, the actual spot VIX right here. You know, on this daily chart, you have a divergent low, just like you had a divergent low here, a divergent low there, one there. You can see that these are labeled. And this is, you know, VIX is kind of like an EKG. And these divergent lows almost always, most often coincide with, actually that before all that was done was that, they most often coincide with, these are positive, aka bullish divergent lows. They typically coincide with negative divergences or divergent highs in the index. And back, you know, we've gamed all these big moves in the VIX in the last couple of years. Even this one back here, a little bit to the left of the chart on the 60-minute chart, we were in at or right off the lows, hitting the price targets. Here, I'll give you VIXY, but I just want to point out that a couple weeks ago, we had this little wedge breakout, and I said we'd either go, that would be it, and we'd start to go up to my next longer term target, or we'd come down here. I had that dotted arrow coming down to 1615, and so far to the button. That's what we did. So this to me still looks like a textbook. You have that nice, remember we had a divergent low there that could have done the trick, just like that relatively small divergent low gave us that big 240% rally. Or I had us doing this, and that's what happened, and making an even bigger divergent low, just like the indexes have now. So divergent high, that is. And we started to move up. So if this plays out, which, you know, I still lean towards, that means the market's going to surprise everybody. And when I say everybody, guys, I am struggling. I read a lot. I read the headline. I follow the different media sources. During market moving things like today's Fed announcement, then I'll turn on CNBC just to kind of get the immediate response. And you're forced to listen to these bobbleheads. For the life of me, I can't find one of them that's bearish. They're all so bullish right now. All the articles I read saying, oh, everybody's been out of this market because of all the uncertainty since the trade war started. There's going to be this mountain of cash. We're going to see this blow off big top. Everyone's going to come back into the market. Maybe so, but when everybody is thinking the same thing, that rarely happens. Again, I go off the charts. You know my levels. You know when these divergences will start to be taken out, when it's just more than a marginal new high. But as of now, VIXY is the there's the same wedge here. If this market does what nobody thinks, very few I should say, nobody obviously, if it does what the vast majority, the opposite of what the vast majority thinks, the vast majority expect at minimum a breakout to new highs, and quite a few are talking this explosive. Tom Lee's doing the same thing he did back when the market was right here. the market plunged earlier this year when we were short, calling for a rip your face off rally. Well, he got his face ripped off, but in the wrong direction. Market plunged into the April lows this year, and of course he's calling for the same thing. But the joke there is he's bullish on every day of the week that ends with a Y. So again, I don't put too much stock in that. Everybody thinks there'll be a lot of money coming into the market and in this big kind of explosive rally once it breaks out to new highs. We'll see. Guys, I go off the charts here, and if they start telling me something different or look any different, I'll let you know. This is the current trade right here on VIXY. It's played out. We've been playing this thing like a grand piano. T1 hit, pullback zone right here, this purple box. Close your longs, buy it back there, or the VIX long, after whatever that is, high double digit, triple digit run, whatever it was. Back in, hit T2, get out, short it, scale back in here. We're back in that scaling zone at the bottom of it. And again, I've just showed you what it looks like on the shorter term chart. You can even draw these divergences. They come through now on the daily. That's what this kind of sideways action in the market did. It gave us that, what we didn't have a few weeks back. When we pulled back here, we didn't have negative divergence on the daily time frame on the stock market, nor positive divergence on the VIX, which we do now. So again, from a technical perspective, and you've heard me say this once, you've heard me say it 1,000 times, good effing luck to you if you try trading off the news headlines. If you try figuring out what the next tweet or Truth Social post from Donald Trump is going to be, if you try figuring out which way this thing in the Middle East is going to go, whether we're going to join drop the bunker buster bombs and get involved, whether we're not, good luck on trying to guess the next GDP report or economic report. Anyway, this is all I can go off of. The day you meet an active trader that trades for a living professionally, that trades off news headlines, let me know, because that'll be a first. Traders have to use the charts, and right now the charts are still saying the same thing, or this market's still sitting here. And I can tell you, and I've said it 1,000 times, divergences are not the be-all, end-all. Overbought, oversold does not guarantee trend reversals. They're just merely conditions that typically, and more often than not, precede trend reversals. So I have seen times where they're powered through, and then overbought or oversold becomes more overbought or oversold. Divergences either continue to build, get even bigger, and then play out weeks or months later, or sometimes get taken out and never play out at all. So that's all I can tell you. So you have the levels to watch. I started the video with on QQQ and SPY, and we'll see where we go from there. All right, let's talk now USO. I gave you that update today in yesterday's video, what I was explaining. Thank you for the subscriber who pointed that out. I had USO on top of USO, but I gave you the chart today, the correct chart with QQQ above it. And they mirrored each other because it's the same reason. It's crude hits my orange zone. And remember, I started throwing the orange zone out right here at the beginning of 2024, but I extended it just for that point because I covered it in the video yesterday, and I don't have that pair of charts. I had to manually replicate two charts above each other that would fit into this screen capture software. I'm running, this on a I have multi-monitor position setup, and this is just a small part of a 43-inch monitor. As I drag around, you can see charts everywhere, and so I'm only capturing a small part of it. And I had to put two charts in there, and I happened to, in the dry run, I had QQQ over USO. But again, I gave it to you today, and like I said, without exception, a 0% failure rate. Every time that we've crossed in the orange zone, that's the chart I gave you today. And this one time we entered the red zone. This is before I had it. I came up with the zones based on, okay, where in the past and where from my experience would the levels start to matter, where what I see then the masses would soon start to see and talk about. And that was it. And that's these zones. So I have nothing else to add other than we are now kissing. And look how many times we've hit the red zone, come up to the red zone. We punched into it briefly there And of course, that was followed by the biggest drop in years, which we gained with impunity, high to low. And we're here now again. So, um, anyway, so if you want to know what may make the 99% of the world that thinks this market's going to new highs and beyond right now not do it, this is it right here. And they'll come out and they'll cry, well, yeah, but it was because of the conflict in the Middle East. Otherwise, again, the technicals already were pointing to something was going to come up to put the brakes on this rally. This rally is like, it reminds me of, growing up and and watching Mike Tyson. I love boxing, and he was the GOAT, back in the day, undoubtedly. And his fights were just incredible to watch. Nobody could stop the guy. He knocked people out in the first, second, third round. He was a phenom until one day he met up with this guy named James Buster Douglas, who knocked out Mike Tyson. So just like this market that seems absolutely bulletproof, nothing can stop it. It's shrugging off. Good news is good news for it, and bad news is just dismissed. But then one day, it's just going to take that one uppercut that's going to knock this market out. Whether it happens tomorrow or 2-3 months from now, we'll see. But right now, it has been shrugging off bad news, but it stopped going up, as I just showed you. It hasn't gone anywhere in the past month. And that is always not always, but most tops are slow turns. Bottoms are usually V's in the stock market. I know we're on crude here. And so if you want to know fundamentally what can knock this market out, you're looking at it right here. It doesn't seem to be concerned with tariffs anymore. It doesn't seem to be concerned with outright war in the Middle East. Again, this isn't a skirmish. That is a direct act of war. What Israel's doing to Iran, and the market's taking that in stride as well. So, and that's the thing. The market doesn't care about blood, and I hate to say it. We've seen that many times since 9/11. 9/11 was kind of a one-off, but since then, terrorist attacks around the world, even Americans being killed, the market doesn't care. It marches on because it knows that doesn't affect earnings to Apple and Amazon. But what the market will not tolerate, especially in a hyperinflationary environment, is high oil. So there it is, guys. Watch it. And again, as I said this morning, it is twofold. It's just like Treasury yields. It is a function of how high we go up in here. We cross into the red zone, and how long we stay. These little one and dones, they have been the catalyst. That's all it took getting up there. And then ultimately, each and every time we hit my zones, the price of oil abated. It did it twofold, but the fundamental cause is the stock market goes down, and then all of a sudden people associate a falling stock market with increased chance of a recession, falling future profits in the stock market, and therefore demand destruction in crude. God forbid we start seeing the market fall and crude stay up. That would be just about the most bearish scenario you could see. So continue to watch it. I make predictions every day. I'm not predicting this is going to go to any one certain level. What I'm telling you is act on it, and that just recognize that, because if the market breaks out to new highs this week or next, and you see oil doing this, then that tells me with a high degree of confidence that breakout's not going to stick. That sooner than later, the market will turn its focus to this. Likewise, if oil just does this the next few days, and Israel and Iran start holding hands and singing Kumbaya, and this is all good, or for whatever reason oil comes down, that would help support the case for new highs in the stock market. But that's right now, again, you're pushing the red line here, the red zone, right at the top of the orange zone. So that's that. And then on the not the flip side, TYX, Treasury bonds, same kind of thing. Yields remain persistently high within what I still call a bad day or two, meaning anything that triggers a sharp rise in long-term yields has the potential to break the 30-year bond out to new multi-year, even multi-decade highs. And as I've been also doing for you for over a year now, the zones and IEF. And same kind of thing as the USO or crude oil zones. This is where my orange zone begins right here. And also each and every time we've went into the orange zone, we just kissed it the other day. Very slight kiss, bounced, and this is where we're at. We're right at the top between the green and the yellow zone. So continue to watch this. And again, I do these long-winded videos because it's everything collectively. There's not any one thing. Even crude oil, as much of an impact, as big as it is, these things are all, each and every one of them and themselves aren't binary, not like, okay, all into the stock market, long, bullish, all out. It's collectively. If you see crude prices going up and you see treasury yields going up, meaning treasury bond prices falling, it just further increases the odds, because those are net negatives to the stock market, further increases the odds that you're going to get the next correction. Okay, so again, not to beat a dead horse on this stuff, been covering it almost daily recently, levels to watch. And remember, all of this goes the other way. If organically yields continue to fall, that means the price of bonds go up. And it is. Again, there's a big important asterisk or caveat here. Any advance due to strong stock market sell-off will be a flight to safety bid, and that's net bearish. But if organically rates go down, the 10-year and the 30-year, they start to fall, and it's not associated with a flight to safety bid because something else is going on, that's rattling the markets. That's net bullish. And then also, as I mentioned way back here, over a year ago, impact on the economy of rising rates is a function of the price levels as well as the time below the green zone, like I said before. In other words, the longer rates stay higher, more and more corporations will be refinancing, have to. Corporations, there are cash flush corporations like the Apples of the world. They have debt only because the Fed created an excess environment, a risk-on environment with the having a zero rate interest policy for years, since the financial crisis, pretty much for over a decade. And then companies that didn't need to borrow a red cent because they were so flush with cash. That used to be Apple's biggest problem. What do we do with all our cash? Where do we put it? We buy companies and we get interest on it, high interest bearing accounts. The companies like that started issuing bonds because it was so cheap, and they could use that to then gun their stock price by doing stock repurchases. So what I'm getting at is most companies, especially your small caps, are highly dependent on borrowing. And so the longer rates stay high, you're going to see more and more of those companies that were able to borrow back here. Let me turn back to rates. Let's do the 10-year right here, TNX. And so let's go to daily chart. And let's go to weekly chart. It's just so you can kind of get the big picture. So here's the 10-year. So what you had here is what is it? I think it's 5 to 7 years roughly on large cap companies. And I think it's about 4 to 5, something like that on small caps, the average maturity on their bonds. So you had just everybody and their brother. I don't know who didn't. I told you guys this. I have a mortgage only because rates were so cheap. Why not take the free money when I bought the house in COVID? And then I turned around and refinanced a 3.5% mortgage at 2.49 with points back. That's free money. I don't want to. Why would I ever pay that mortgage off? Tax deductible 2.49% is literally like free money. So my point is, a lot of companies did that. However, I locked in 30 years. You've got a lot of companies that locked in here. Again, if a company that had debt did not refinance that debt at this point, their CFO, whoever's in charge of that, should not only be fired, they should be quartered and drawn. So they all did it. You had to when COVID hit. So the point is, here's that debt wall that I haven't heard anybody talking about anymore, because the worry was it would start in 2024, 2025, and it's still very real. In other words, all these bonds are starting to come due now and will be coming due going forward. And the $1 million question, if it's this that they're rolling over at, if interest rates break out to new highs and do this, it will be, I'll use the word catastrophic. It'll be catastrophic to the markets, and that's what I think is going to happen. If this happens, and again, if it's on organic forces, not because the market crumbling on its own weight and stock prices crashing, obviously that in itself is bearish, but that could cause yields to come down. That would be good. But even if we stay right here where we're at, think of the interest expense. We already know what's going on. You read about it with the federal government. The huge cost right now are interest expenses. We're rolling treasuries to continue to finance our huge deficit spending. That's the same thing with companies. And guys, I've been talking about this, but on and off for a little while. Others have. I'm not the only one. It's a well-known thing, but this takes time, and nobody has. I don't think there's. It's kind of an obscure picture. There's not any one chart or graph that has the exact numbers of all the thousands of companies out in the financial markets that have debt coming due. So we just know it's in this area. And again, we know that by the average. Some might have extended out their maturities when they had these low, super low rates right here. But with little doubt, it's going to be more and more coming due. So this is what's going to determine where the stock market goes in the coming years right here. And we'll see. So that's why I continue to harp and watch these rates closely and watch those zones and things like oil. You might think has nothing to do. It has everything to do with rates. That's one reason the Fed continues to hold off on cutting rates, because they keep seeing all these things coming up. Trump's big bloated bill. They got to worry about how inflationary that's going to be. The tariffs, the net effect's not over on those yet. And now we have conflict in the Middle East, where a lot of the world's oil comes from. So you've got all those forces that are just keeping these interest rates persistently high and at risk. Again, right now, the risk, since you're closer to breaking out to new multi-year highs than you are breaking down below this trading range, I'm talking about this multi-year trading range right here, the risk right now is skewed to breaking out to the upside, right? Just like the stock market right now, the risk, obviously, it's higher that it's going to break out the new highs than to break down anytime soon, at least on the daily charts right there, on the long-term charts. Okay, and then talking about things that affect other things, let's talk about the dollar. Most here, very few. I know once in a while I get some currency traders on the site. I closely monitor the currencies, the big pairs, the U.S. dollar, the U.S. dollar index, and that I'll also monitor the euro very closely, because the dollar index, for those of you not familiar, the dollar in a vacuum is nothing. The dollar is only relative in an index against other currencies. And the dollar index itself is made up of mostly the euro. It's a 57.6% weighting in the dollar index. So the euro is basically the dollar in reverse. The yen comes in at a distant second at 23 I've got it down here. No, I'm sorry, 13.6. Everything else you can put in the Swiss franc or whatever, the euro. Well, you got the euro in there, the British pound. You can put in, all these other currencies around the world. The Brazilian real, the Mexican peso. They don't move the needle, so you only have to watch the euro or the dollar index itself. And so when we're watching the euro, what I see is a huge bearish rising wedge pattern. Gold, and I've covered this many times. Here, I'll just do it for you quick. If you want to compare, go to FXE, which is a Euro ETF, because it trades around the clock. I mean, this is an ETF. The Forex pair I was just on trades around the clock, and I'm going to compare this to GLD right here, gold, and just show you. You got to go to a weekly chart really to see the comparison, because we've had a very strong, unusually strong bid for gold when it broke out to new highs. So you've had a somewhat of a disconnect on the correlation, but here we go. Gold, you go right here. And as you can see, over time, and you got to look at it over time, typically they go up together. This is the euro rising, meaning, remember, when the euro is going up, this top arrow, the dollar is falling. Gold goes up. They look at the turns and look at the overall trends within. You have brief periods like this of right here was a disconnect. But overall, and look at the major inflection points. Major inflection point there, drop. They were both falling. They both bottomed around right here. There's an inflection point there. There was a brief period of a disconnect right there. But then right there, you can see there was a peak in the gold and a peak in the euro. Euro fell. Doesn't look like much, but that was a bear market in gold. It fell. And then you can see they both bottomed here. And this has been a bull market in the euro. and a bull market in gold. Not mere coincidence, especially this blow off top in gold right here, which it appears to be is this strong surge in the euro. So when we go now to the daily chart, what I can tell you is this is a divergent high right here. I already had the EUR USD marked out. Let me go back to there. Let me go back to EUR USD. It's just the one I follow more because it trades around the clock. So there it is, a beautiful little uptrend line. We're right on the line now. Big, big, big negative divergence, just like you had a divergent high right here, and you had the biggest drop in years that followed right there. And just like you had a divergent low there, and you had the biggest rally in years, right? Divergent high, drop, divergent high, drop, divergent high, drop. Divergent low, huge divergent low back here, and big rally. So that's it. And so this tells me if it breaks down and goes, I cannot promise you gold will fall, but I can promise you that's a net headwind for gold, especially this one right here, GLD or gold GC, gold futures, meaning gold that's denominated in US dollars, and it's an immutable correlation there in the fact that when the dollar drops, it takes more dollars to buy an ounce of gold. So if you freeze supply and demand, gold will go up. And likewise, if the dollar falls, which or rallies, I should say, which is what we're looking at now, then gold will fall because it takes more dollars to buy fewer dollars to buy an ounce of gold, right? So there it is. So there's the uptrend line, which looks just like the euro right there, bearish rising wedge, marginal new high. Look for a breakdown of this uptrend line right here. That would be your sell signal in gold. And you can also chart, which I would encourage you because sometimes it gives you a head start. If the euro breaks down, there's your bearish rising wedge on the euro. And likewise, as I've covered now for the past couple months, this massive big trading range in the dollar index via UUP, the ETN. This is where it's come down to all the way since 2022 right here. And this big drop here in the dollar, you can see you had a beautiful little, as highlighted at the time, bearish rising wedge with that's a divergent high. That was a divergent high right there. I don't have them all labeled. You can see the bearish rising wedge, divergent high, sent us down to the bottom, bounced up back to the top of the range, put in a divergent high, broke our trend line, giving us a sell signal there. That was this big drop here. That happened when was that peak in the beginning of January right there. What did gold do from there? Dollar fell, gold ripped, exploded higher. Again, farthest thing in the world from mere coincidence. And so now, again, there is no guarantee. There's no guarantee to any of this, but this is the most likely scenario. As long as the dollar holds support, if it breaks out, it's going to run up. You may want to run and back test this trend line. Again, what I can tell you, it would be a net headwind for gold. A net headwind doesn't necessarily mean gold must drop. It probably will. It just says because the impact on the rising dollar should slow down or offset any demand in gold, and most likely will coincide with a correction in gold. And again, you line up these trend lines, set your price alerts. You know, somebody asked me today when I sent a post out on one of those trades that hit a price target. Hey, I got my email 20 minutes late. And what I said is you should always have, I don't care who you are, myself included, I have sell limit orders at the price target or targets I'm targeting, because so often my targets are very precise and I hit the securities hit those targets and immediately reverse. You can't act that fast, even if you're in front of the computer all day. So set those orders and have a limit order, good to cancel at your preferred price target or targets. And then now regarding this kind of stuff, even if you don't have any desire to trade the dollar, set a price alert here. And also set a price alert on the EUR USD pair or FXE if you want to use that. And then if it breaks out, you have my targets. If it runs up there to this first target, it's a good target. We probably have a pullback. So when you drop in gold, that's where the dollar will probably pull back, and the first rally and counter trend bounce in gold will come. But then you'll also have put in this W pattern right here. So ultimately then if you break above that, you're going to head up to some of these higher targets. So there's a pretty comprehensive, but again, I always do that. I cover, and to me, any analysis on gold is incomplete without an analysis on the US dollar. Silver, big, what I call unconfirmed divergent high, wash, rinse, repeat. You know, it's been walking its way up. Divergent high, divergent high. These are little swing trades that we've been able to have. You just look for these divergent highs, but the divergence keeps getting bigger and bigger as time goes on here. And I call it unconfirmed because, again, it's a term I've made up. I want to see the PPO make a bearish crossover to effectively put in a lower high. Otherwise, it's a momentum indicator and it can keep going up, and then we no longer have divergence. So if we get that divergence confirmed, give us a sell signal. I know on the 60-minute chart, both on SLV, which we're looking at here, the ETF, as well as the futures, I have a bearish rising wedge pattern. Shows better on the futures. That just broke down, so that's a sell signal on silver. Silver looks like a nice short here. Let me show you my futures chart. That is what it looks like, SI, for you silver futures traders. You had that little divergent high right there, I believe highlighted at the time, big drop. And now we have the first divergent high on the 60-minute chart in a while. These just rolled recently, so I had to replicate this chart from the previous chart. So that's it. You've got some support there. You can see some levels. That's an ideal target, minimum target right there, about $34 on SI silver futures. But again, let's not forget the charts. This is on the daily chart. That's pretty big divergence. You go out to weekly chart. Let me turn off the comparisons. Turn off the comparisons. Turn on back my lines. Just big divergence has been building on silver for a while. And, not a complete blow off top, not as much as in gold. Silver's just been playing a catch up to gold. Remember, silver just punched out to a recent new multi-year high because gold had already done so. Gold might have eked out. I can't remember if it was. It's so close. Again, you can see this little box here. Gold's just gone sideways like the market. So I haven't covered it very much lately, but I am doing this, kind of giving you a pretty detailed analysis right now because it looks like this thing's ready to crack to the downside anytime soon here. But again, as I often say, this is what we call a trade setup. No sell signal, no break of support, or no break of support, no sell signal. We could keep riding up that trend line, keep bouncing. Same thing with the euro-US dollar. But when you see the euro-US dollar pair, FXE, UUP, or DX, I mean, you can do it any way you want here, guys. I look at them all because I want to see the more that break out, the better. I'm talking about the futures. I'm talking about the dollar index. I'm talking about the euro. Let me show you my DX chart. All right, DX are the US dollar futures. So if you're a futures trader, you probably already know that. It's a textbook bullish falling wedge pattern, complete with the, what I like to say, requisite positive divergences on a bullish falling wedge. I like to see that. 6-month chart, 2-hour candles. Pop there, you're going to go up here. My first target, 99,772, and then 101.22. Then 102.468, and maybe all the way up here. So there's your setup right there. And if you just simply set price alerts on all of these, or just watch them if you're in front of the computer, they all break out. And let's just say on that day you see the currencies breaking out, the dollar's breaking out, euro's breaking down, but gold's up. You might have an opportunity there to fade that rally in gold because it will probably fail shortly thereafter. A lot of times I've noticed. I know that a lot of the retail folks, I've been doing this for many years. I know a lot of people trade gold just based on gold. They'll buy a breakout. And again, I never trade it without watching the dollar to confirm if I'm bullish on gold or bearish on gold. I want to make sure I can make a case the other way with the dollar. If not, I'll just step aside. If the charts are ambiguous, I may just pass on the trade, or if sometimes they're going the other way as well. All right, guys, I'm going to stop. Let me see. I think that's it. Yeah, I'll stop the video here. I'll do the trade ID updates in a separate video. I know MasterCard and the MA, Visa, and American Express trades, they had some nice downside traction today. They still look good. And everything else I'll try to get to in another video tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.